December 12, 2025. Bank of America releases a report that sent shockwaves through commodity markets. Their new silver price target, $120 per ounce. Not $70, not $85, $120. That's nearly double current prices from one of the world's largest banks. The same bank that called gold's rise to $3,000, the same analysts who predicted the copper shortage. They're now saying silver could surge 87% from current levels. But here's what caught my attention. It's not their target that matters, it's their reasoning. Because buried in that 47-page report is a sentence that changes everything. And by the end of this video, you'll understand why Bank of America isn't being bullish. They're being realistic. Let me show you something most people don't understand about Wall Street price targets. Banks aren't in the prediction business. They're in the client positioning business. Here's how it actually works. When commodities are out of favor, when nobody's paying attention, banks publish conservative targets. Not because they don't see the potential, because their clients aren't positioned yet. They need time to accumulate quietly before the herd arrives. Then something shifts. The fundamentals become undeniable. Supply deficits, demand surges, physical shortages. Now the bank has a problem. Their biggest clients are loaded. They need liquidity to sell into. They need buyers. That's when the aggressive targets get published. $120 per ounce. Triple-digit forecasts. Not to inform you, to create the demand their clients need to exit profitably. But here's the thing. Sometimes the targets aren't manipulation. Sometimes the data forces their hand. Sometimes the fundamentals are so overwhelmingly bullish that even conservative Wall Street analysts have to publish numbers that sound crazy. You can tell the difference by looking at their methodology. If it's vague, if it's based on sentiment and technical analysis, it's probably positioning. If it's based on supply-demand math, refinery capacity, industrial consumption rates, that's different. That's them admitting reality. Bank of America's $120 target? It's the second kind, and that should terrify you. Because when Wall Street publishes targets they can't mathematically avoid, it means the move is already inevitable. But before we break down Bank of America's analysis, you need to understand the historical context. Because $120 silver isn't unprecedented. It's actually overdue. January 1980. Silver hits $48.45. The Hunt brothers tried to corner the market. ComEx changed the rules. The price collapsed. Everyone remembers the crash. But here's what they forget. Adjust that $48.45 for inflation. In today's dollars, that's approximately $178 per ounce. We're at $64 right now. We haven't even reached half the inflation-adjusted 1980 peak. But wait, it gets better. In 1980, silver wasn't essential for solar panels, wasn't critical for electric vehicles, wasn't required for 5G infrastructure. Industrial demand was a fraction of what it is today. In 1980, there was no supply deficit. Mine production was increasing. Above-ground inventories were massive. The shortage was artificial, created by the Hunts buying everything. Today, we're in the fifth consecutive year of structural deficit. Industrial consumption exceeds mine production by 200+ million ounces annually. The shortage is real, not manipulated. In 1980, institutional investors weren't buying silver. No ETFs existed. No sovereign wealth funds accumulating. It was retail and the Hunt brothers. Today, BlackRock, State Street, institutional flows at record levels. Central banks exploring precious metals for reserve diversification. So when Bank of America says $120, they're not calling for new highs. They're calling for silver to reach 67% of its inflation-adjusted 1980 peak in a market with exponentially better fundamentals. That's not bullish, that's mathematical. Now, let me break down exactly what Bank of America's report says. Because they didn't just pick $120 randomly, they built their case on three fundamental pillars. Pillar 1, the supply crisis. According to their analysis, global silver production peaked in 2016 at approximately 900 million ounces. By 2025, production has declined to roughly 813 million ounces. That's a 10% drop over 9 years. But demand? Industrial demand alone hit 1.1 billion ounces in 2025. That's a 287 million ounce deficit before you count investment demand. Bank of America projects this deficit continues through 2027 at minimum. Cumulative shortage by end of 2027 over 1.2 billion ounces. That's 150% of annual global production just gone. And here's their key insight. New mine production takes 7 to 10 years from discovery to first pour. Even if companies started developing projects today, no new supply arrives until 2032 to 2035. The deficit is locked in. There's no solution in any time frame that matters. Pillar 2. Solar demand explosion. This is where Bank of America's analysis gets really interesting. They're not using current solar installation data, they're using government mandates. European Union, net zero by 2050. That requires approximately 400 gigawatts of new solar capacity by 2030. China, 1,200 gigawatts of solar target by 2030. They're currently at 600 gigawatts. United States, Infrastructure Investment and Jobs Act allocates $550 billion for clean energy. Solar is the primary beneficiary. Every gigawatt requires approximately 1 million ounces of silver for panels. Bank of America calculates that solar demand alone could hit 800 million to 1 billion ounces annually by 2028. That's more than total global mine production, just for solar panels. And there's no substitute at scale. Copper oxidizes. Aluminum doesn't conduct efficiently enough. Silver is the only material that maintains performance in high temperature, high humidity environments for 25 plus years. The solar revolution isn't optional. It's mandated by law across 3 continents. Pillar 3. The paper market breaking. This is the most explosive part of their analysis. Bank of America acknowledges what traders have known for years. The paper silver market is over-leveraged. ComEx open interest, 244% of registered inventory. For every physical ounce, there are 2.44 paper claims. London lease rates spiked to 39%, annualized in November 2025. That's the highest on record. It means physical silver holders won't lend metal because they're concerned they won't get it back. Shanghai premiums, Chinese spot prices trading 3% to 5% above London and New York. Physical metal commands a premium over paper contracts. Bank of America's conclusion: the bifurcation between paper and physical markets suggests systemic stress. Historical precedents indicate such stress resolves through violent price appreciation rather than demand destruction. Translation: when paper and physical decouple, the paper market breaks, and physical prices go parabolic. So, how did Bank of America arrive at exactly $120? Let me show you their calculation methodology. They use 3 valuation approaches and take the midpoint. Approach 1. Supply-demand balance. To incentivize new mine production, silver needs to reach levels where previously uneconomic deposits become profitable. Bank of America estimates the marginal cost of production for new primary silver mines at approximately $85 to $95 per ounce. But markets don't just reach marginal cost. They overshoot. A 25% premium to marginal cost puts silver at $106 to $119. Midpoint, $112. Approach 2. Gold to silver ratio reversion. Historical 20-year average ratio, approximately 60 to 1. Current ratio, 72 to 1. Gold at $4,200 implies silver should be at $70 based on current ratio. But Bank of America notes that during supply stress periods, the ratio compresses dramatically. In 2011, ratio hit 32 to 1. In 1980, ratio briefly touched 17 to 1. They project ratio compression to 40 to 1 as physical scarcity becomes undeniable. Gold at $4,200 divided by 40 equals $105. If gold appreciates to their $4,800 target, silver at 40 to 1 ratio means $120. Approach 3. Industrial panic premium. This is the most interesting calculation. Bank of America models what happens when industrial users realize physical supply is genuinely constrained. Solar manufacturers facing production line shutdowns will pay premiums to secure supply. EVs manufacturers can't ship vehicles without electronics. Defense contractors have no price ceiling for national security materials. Bank of America estimates industrial users would pay up to 80% above current spot to guarantee delivery and avoid production disruptions. $64 plus 80% equals $115. Average of 3 approaches, $112 plus $120 plus $115 divided by 3 equals $115.67. They round to $120 for a clean target. But here's the critical question. When does Bank of America expect silver to reach $120? Their base case, 18 to 24 months. That puts the target window at mid-2026 to late 2027. But they include an important caveat in their report. The timeline assumes orderly market adjustment. Disorderly adjustment, triggered by delivery defaults or sudden industrial shortages, could compress the timeline significantly. Translation: if the paper market breaks, if ComEx faces delivery failures, if major industrial users publicly announce they cannot source silver, $120 happens in months, not years. And here's what makes their timeline interesting. They published this target December 2025. right as we're entering Q1 2026. Right as U.S. tariffs on imported silver are expected to be implemented, that timing isn't coincidental. Bank of America sees the catalysts lining up. Tariffs hit, industrial panic buying accelerates, physical premiums explode, paper market stress intensifies. The perfect storm for their forecast to materialize faster than their conservative timeline suggests. Now, Bank of America isn't alone. Let's look at what other major institutions are projecting for silver. Goldman Sachs raised target to $95 in November 2025. Their analysis focuses on industrial demand and green energy transition. Citi updated forecast to $100 by end of 2026, emphasis on supply deficits and mine production declines. UBS target range of $85 to $110, depending on solar installation rates and EV adoption curves. JP Morgan, no official published target, but trading desk commentary suggests internal models showing $90 to $125 range. Notice the pattern? Every major bank has targets between $85 and $120. The consensus is forming. This isn't one outlier making a crazy call. This is institutional Wall Street agreeing that silver is fundamentally mispriced. And when Wall Street consensus forms around a commodity being 50% to 100% undervalued, two things happen. First, institutional buying accelerates. Second, the move happens faster than anyone expects. But let's be intellectually honest. What could make Bank of America wrong? What could prevent silver from reaching $120? Scenario 1. Economic collapse. A severe global recession crushes industrial demand. Solar installations pause. EV production cuts. Demand destruction overwhelms supply deficit. My take, possible but unlikely. Even in the 2008 to 2009 recession, silver only dropped to $9 before recovering to $48 by 2011. Economic stress typically drives monetary demand that offsets industrial decline. Scenario 2. Technological substitute. A breakthrough material replaces silver in solar panels and electronics. Cheaper, better performance, abundant supply. My take, extremely unlikely. Silver's unique properties, conductivity, reflectivity, corrosion resistance, aren't easily replicated. Decades of R&D haven't found viable substitutes at scale. Scenario 3. Massive supply discovery. A giant new silver deposit gets discovered and brought online quickly, flooding the market. My take, impossible on the timeline that matters. As Bank of America notes, mine development takes 7 to 10 years minimum. Even if a discovery happened tomorrow, no new supply before 2032. Scenario 4. Demand never materializes. Solar growth slows. EV's adoption stalls. Industrial demand projections were too optimistic. My take. Contradicted by government mandates. The EU, China, and US have legally binding climate targets requiring solar and EVs. It's not forecast, it's law. The bear case requires multiple low-probability events occurring simultaneously. The bull case just requires current trends to continue. Now let me tell you what Bank of America probably knows but can't officially publish. $120 isn't the top. It's a waypoint. Financial institutions can't publish targets too far above current prices. They'd look reckless. Their credibility would suffer. So they publish what's defensible, what their models conservatively support. But privately, look at the trading activity. Look at the option positioning. Someone is buying $150 calls. Someone is accumulating $200 strikes. Because if Bank of America's three pillars are correct, if the supply deficit is real, if solar demand materializes, if the paper market breaks, $120 is just where the acceleration begins. Remember 1980. Silver went from $11 to $48 in 14 months. That's a 336% move. Apply the same percentage gain from current $64 levels, you get $279. I'm not saying that happens. I'm saying when physical shortages meet industrial panic, meet paper market failure, the math doesn't care about analyst price targets. The market finds clearing prices. And clearing prices in commodity shortages are always higher than anyone predicts. Bank of America's $120 silver target, 87% upside from current levels. Timeline, 18 to 24 months, possibly much faster. Three pillars. Supply crisis with no solution. Solar demand explosion backed by legal mandates. Paper market stress indicating systemic breakdown. This isn't one analyst making a bold call. This is institutional Wall Street acknowledging what the fundamentals have been screaming for years. Silver is profoundly undervalued relative to supply-demand reality. The question isn't if silver reaches $120. The question is how fast and what happens when it gets there. If you understand what Bank of America sees, if you recognize the pattern forming, subscribe right now, because the next video reveals which silver miners Bank of America's research desk is quietly accumulating. The company is positioned to 5x to 10x when silver hits $120. Hit subscribe. The largest institutions on Wall Street are positioning for triple-digit silver. The only question is whether you'll be positioned with them. Don't miss what's coming.